of Money with Santosh Sirur.
Hello and welcome to another episode of The Sound of Money. With me on this show, on this episode of The Sound of Money, we have from Delhi, Mr. Neeraj Chauhan, who is a certified financial planner. And he's the one who has been very instrumental and set up the financial mall. We'll get to know a lot more about the financial mall, but first, let's welcome Neeraj. Hi, Neeraj, and welcome to The Sound of Money.
Hi, Santosh, and thank you so much for having me on the show.
Yeah, so Neeraj, today let's discuss about mutual funds. So we all know there are various different types of investments, right? Starting from an FD to shares to deposits to even mutual funds. A lot of times general investor has money in hand but doesn't know what really what like to invest in. Of course, it also depends on the market situation. But before we get or delve into mutual funds per se, Neeraj, can you let us know what is your reading of the current Indian economy before we really get into it?
Very pertinent question, Santosh. At this point in time, when there is a global turmoil, if you look at various other economies in the world, be it a developed economy or an emerging economy, everyone is in some kind of a pain. Somewhere there is so much of inflation and the rate of interest is going up. Somewhere there is an energy crisis. Uh, and, we are not globally uncoupled. But having said that, so far Indian economy has kind of shrugged off all these fears, and they are doing phenomenally well. If you look at the numbers are quite encouraging. Our tax collections are going up, economy is doing good, our productions are kind of expansions are happening in the industries, and we don't see that kind of a gloomy situation in India as of now. How it translates in future, everybody has to see here. But if you look at the various reports, whether it is IMF or global reports, everyone is looking at India as a shining star, and there are various reasons to it. We had not done so great in the past, and we have to catch up various economies. But there's certain good policies which has actually helped the Indian economy, be it digitalization, be it spending money on the infrastructure and so on. So yes, as of now, I think Indian economy is doing pretty well. We are kind of, I will not say 100% isolated, but yes, we are kind of done well in these downward situations as well.
Okay. I think possibly a lot of our listeners and our audience, basically, when it comes to investing their surplus. So one is the savings itself, but beyond the savings are your surplus, what you have in hand. The question comes is key, oh, should I invest in a fixed deposit because that's more stable, more safe, and I know the bank. But then there are other options where the rates of return are much better, and that's where the mutual funds could come in. So it's a dichotomy. So what kind of advice do you give to such an audience or a listener who probably has no idea about what to go in for?
Okay, Santosh. So we have to categorize the investors here. There are various kind of investors. There are investors who have met all their goals in life, and they have some money surplus which they want to deploy. And the whole idea behind the deployment of such funds is to enhance the wealth. That's the one category of investor. Other category of investor might be that they have still their goals in hand, which they want to accomplish. Uh, Maybe it's a goal to send kids for the education somewhere. Maybe it's a goal for their financial freedom. Maybe it's a goal to buy a house. So it all depends. So we cannot categorize all the investor in one bucket. Accordingly, whenever it comes to the instrument, it boils down to which actually what they want to have. So, as the mute question is why they want to invest, basis which they can have an instrument according to their objectives, their goals. So, hypothetically, let's see if the idea is to enhance the wealth, right? And maybe the wealth is to be passed over to next generation. Then, of course, no matter what, they can always look at a asset class which can deliver them the highest return. And one thing in common, Santosh, whenever we speak to investors, be it in any category, they always say that we need a maximum returns with the minimum risk,
Yeah.
right? So that's the general reply to most of the questions whenever we ask. And it's only in theory, it can never happen. Economics gets divided. If you have to take a higher return, you may have to take a risk, or I would say you'll have to pay the risk premium for it.
Yeah.
So, as we all know that equity is asset class which delivers phenomenal returns, but of course they carry risk with them and various kind of risk. So, to give the short answer to the question is, it all boils down what actually you are looking at, why you want to invest. So that's the first very most important to ask themselves, and then only a financial planner or advisor can help them to choose the right instrument.
Yeah. So you brought this very important point about the investment behavior, right? And the goals that one sets in life. So if you could just give a ballpark of what could those goals be, and how could one plan accordingly to invest before we really get into the subject of mutual funds? A very generic response on what kind of investment behavior have you come across in your career, and how do you kind of advise such investors?
So, Santosh, the most important questions they need to ask themselves before speaking to any financial planner or anything is why they want to invest. Right? As you said that what are the kind of goals? Goal can be any. Goal can be as short as, okay, I want to buy a car in next 5 years. Goal can be, I want to buy a house in next 6, 7, 8 years. Goal can be, I want to send my kids abroad for education. Goal can be, okay, I want to hang my boots at the age 45, 50. So honestly, most of the time, people, when they meet us, they have no clue about it. They don't have their numbers in place. What is that quantum of money which they need? They don't have that timeline clarity. What is
Yeah.
the timeline for the goals? And unless you have these numbers, you will invest just like that. You will just chase the instruments rather than structuring your entire investment plan. Uh, be it fixed deposits, should you invest in equity, should you invest in gold, and what they will do that in the absence of this clarity, they will always keep of chasing, okay, what is the good sector to invest in? Oh, tell me which is the good return instrument right now. Okay, how the property looks like. So these are the common questions people will ask when they don't have a clarity on their goals and objectives. So once that clarity comes, it becomes crystal clear why should they invest in equity. For example, if someone has a goal in next 2 years, no matter how the equity is, they can't put the money therein because it carries a risk, and you can miss your goal if your markets are bad. To give an example, let's say if someone has a kid who is now in class 10th or 8th, and next 2 years or 4 years he has a plan to go US for a higher education. You can't put them into equity, no matter how great they are, no matter how positive outlook is. Because after 4 years, you cannot cut a sorry figure saying, "Oh, sorry, market is down. Please send your kid for education next year or maybe next year."
Yeah.
Right. So, you have to choose the instrument as per the objective, as per the client, and that's where the clarity is required.
Yeah. So Neeraj, that's a pertinent point, right? As you say, a lot of times when the investors reach out to you as certified financial planners, they do not have a crystal clarity about what exactly they want in life. So what kind of homework do you think they should do at home before reaching out, or even on their own? What is it that they could do to begin with?
So, a couple of things. I would say that firstly, it is not a one-member decision in the family. They should involve the family in the whole process, and they start writing it down. Just pen down the financial life of any individual or a family. Let's say today they are sitting down, and today is 2022. So what is their age as of now, right? And from here to next 50 years, how they see their financial life going on. So when are those goals, when are those benchmarks which are going to come across in that life? So for example, in 2 years, are the kids going for education? Yes or no? In 4 years, are they going to buy a house? Yes or no? In 10 years, are they going to be financially free? They plan to be financially free? Answer yes or no. If the answer is yes, what is the amount which is required? So that you have to write that down. And then how many assets they have currently? What is the number? And what is the ask rate they have to meet those goals? What is the kind of investment they need to make accordingly? Right. So that's how they should start doing that exercise, and just pen down the year, the age of each individual in the family, and the goal, and quantify that goal. And then kind of look at holistically in the whole picture. Sometimes some of the goals you may feel like, oh, I cannot meet those goals, and I may have to probably increase the timeline. For example, if my goal to have a financial freedom in age 50, but with the financials currently I have and the kind of income which I have, my surplus is not that great that I can hand my goods. So I may have to defer it. And there are certain goals which you can defer and certain which you can't defer. So you need to prioritize. I may have 10 goals, but I cannot achieve all. So what is the priority? What is priority number 1, 2, 3? When you start writing it, it's kind of clarity and it's kind of goosebumps which comes in.
The reality kya hai?
Yeah, it's a reality check, honestly.
Yeah. Correct. So coming to mutual funds, So coming to
sometimes, Santosh,
carry on.
People defer this exercise.
It is not deferring. People don't want to get into it because unko pata rehta hai ki this is my reality. I have to face it. Probably that also is a crucial factor in the fact that there's a lot of hesitation to go about it.
It is. It's just like, so if you tell someone to go for a medical test and medical checkup, he'll say, no, I don't want to do it.
Yeah, correct.
So yeah, that's a challenge.
Correct. So coming to mutual funds, right? I mean, yes, sometimes a lot of investors who may not be into finance per se, but they're into different professions, are want to go beyond the traditional fixed deposit route, and they at the same time may not have the time, expertise, or the knowledge on stock markets per se, and which probably brings into a middle way, which is the mutual funds. And mutual funds in India have evolved and have given fantastic return over the years. But at the same time, Neeraj, they may have a concern as to may be risk hai kya. So what would your advice be to those such investors who probably, and I've come across people who have been into banking, and not just normal other industry, but even in banking, who have not yet delved into mutual funds. So that's quite surprising, right? And they're still in a traditional FD route. So I'm sure you too have come across such customers in your journey.
Definitely, yes. These are very common questions which are asked day in, day out. But I would say it's just they're not understanding what mutual fund is. And when we say mutual fund, as you said, they are risky. No, they are not. It all depends what kind of a mutual fund you are picking.
Yeah.
For example, if you are picking a mutual fund which is investing into government securities, which is treasury bonds or short-term papers, AAA rated papers, there can be interest rate risk, yes. There can be a default risk, yes. But how much is that? What is the probability of those risks? Right?
Yeah.
On the other hand, if they are investing into some kind of a sectoral fund or a thematic fund, then the risk goes up. So it all depends what kind of an instrument you are choosing within the ambit of mutual funds. And today in India, mutual fund has wide array of instruments available.
Yeah.
From an investment perspective of a week to a 10, 20, 30 years kind of an instrument. So what exactly you are looking at? If you are going to compare your fixed deposit with a mutual fund, there are options available. They are tax efficient. They are not going to give you the equity risk, and of course you'll be beating your fixed deposit by a decent margin. Just to give you an example, let's say there's a debt fund. For a moment, let's pick non-equity instrument. Let's say it's a debt fund, and in the portfolio you have 20, 25, 30 securities of different. You have different kind of papers.
Yeah.
On the other hand, you are making an FD in a cooperative bank, so-called perceived safe instrument.
Yeah.
And maybe some kind of a nationalized bank, which is now guaranteed by RBI up to 5 lakhs.
Yeah.
But thankfully, we have not had that kind of experience where it defaulted. But we had seen a lot of cooperative banks, but they were fixed deposits.
Yeah.
Right? So you lost your entire money. Where in mutual fund, let's say if one paper defaults and the allocation is 2%, 3%, 4%, how much you lose? 4%.
Yeah.
And your mutual fund was delivering you, let's say, 7%, 8%. So your net return is 3% for that financial year. So how are they risky? They are lesser risky as compared to fixed deposit, if you ask me.
Yeah.
And then they are tax efficient. And then they have potential to deliver higher returns because the fund manager can play around with the duration of the papers.
Yeah.
So that's a misnomer that mutual funds are risky. They are not. They are kind of regulated by SEBI, which is a very stringent watchdog here. And he looks around, and whenever he sees there is a loophole, he immediately come and plugs it.
Yeah.
So, it's a regulated environment. transparent instrument. You can see where the money has been put and what kind of a return it is generating. And then you can invest. So, and you have a wide option. You can invest into 100% debt, to 100% equity, to a mix of both, and to a gold. Now we also have foreign funds. If you want to invest into overseas, you want to invest into China, US, Europe, and so many other countries. So I would say it's a very good instrument to have in the basket, and don't just shrug it off with the misnomers. Understand that, ask questions as many as you can, and probably start with a little amount so that you have an experience.
Yeah, absolutely. So you said the little amount, right? And that's exactly, I know there are two ways one can invest. One is the SIP route, where it's the systematic investment plan. It's like, if to a layman, it's like your recurring deposit. Every month, a certain amount is invested in that mutual fund. Otherwise, it could be your lump sum amount. So always there is that debate, but should it be SIP route or should it be lump sum? What are your, and I know the answers, there won't be one right answer or one wrong answer, but what is your view on that? What would you suggest to an average investor?
No, Santosh, there is no debate on it. There is no debate on SIP versus lump sum. It's pretty simple. I don't know why it is complicated and how that notion has peeped into the mind of a lot of investors. SIP is basically you are deploying your money which you are going to earn over a period of time. Invest as you earn. So that's what SIP means. You cannot invest your future money today in a lump sum. Can you? No, you cannot. Right? But if you have money in your bank account, you are not going to do SIP out of it, because you will be losing on that capital.
Correct.
You will be earning 3.5%, 4% vis-a-vis the instrument which is more efficient and effective.
Yeah. Correct.
Right. So there is no debate of having SIP or a lump sum. If you have money in your bank account and the money is free for next couple of years for a particular goal or objective, deploy that immediately.
Straight away.
Straight away. And SIP is your future income, which you are going to earn over a period of time. Deploy that efficiently and effectively so that you grow your wealth. You kind of accumulate money. Right. There is a third way of doing STP. Which is generally we use when the markets are turbulent, when we feel like, okay, it's a kind of a risky, especially when you are investing into equity. That it is risky to deploy money at this point in time, just to stagger the risk. Then you can use a STP mechanism. Otherwise, put lump sum or do SIP for your future.
Okay. And then the mutual fund market has evolved and is absolutely matured, and you have SEBI, which has its own checks and balances. A little bit of an idea about the mutual fund market in India, just to give that kind of confidence to a layman investor who's looking at mutual fund investments.
Santosh, today we have come a decent long way in last 20-25 years. Now we have good amount of investors. Rural participation is also picking up. We have good asset management companies, be it domestic, be it international. We have good players, bigger financial institutions which are there. So now I would not say that this industry is in a nascent stage. No, now industry is pretty decently matured kind of a environment. We don't have that kind of a numbers which are there in American markets, where you have asset management companies in thousands. We are still growing, but yes, we have all kind of asset management companies, from industrial houses to financial institutions, from standalone perspectives, from domestic to international, and doing pretty good. So we have good numbers now. It's not, it's evolving.
Neeraj Chauhan, financial planner for Chief investments, and as a part of your own setup, tell us a little more about your own firm. What kind of services you offer?
So Santosh, we are a financial mall. We are a distributors where we distribute all the financial instruments under one roof. And we are helping people to choose the right instruments as per their goals and objectives.
Okay, that's good. Neeraj Chauhan, thank you so much for joining us on this episode of The Sound of Money. And I'm sure in coming episodes, we'll delve a lot more into this mutual funds and get our listener being aware of what all the kind of different types of mutual funds one can invest in and secure his or her great future. But for now, thank you so much once again for joining on this episode of The Sound of Money.
Thank you, Santosh. Once again, thank you for having me. Bye-bye. Have a nice day.
And well, with that, we come to the end of this episode of The Sound of Money. Join us once again on the next episode as we take forward. Stay safe, take care. Bye-bye.
Sound of Money with Santosh Sirur.